Hey, Mike. Yeah, no surprises here. All 33 banks tested this year remained above their minimum capital requirements, as was expected. This despite a hypothetical $600 billion plus in losses under the scenario outlined by the Fed, thanks to the banks going into the test with high capital levels by historical standards. Now, the aggregate common equity capital ratio, that's a metric that represents the financial health of the banking system, declined to 9.7% under that stressed scenario, but that's still more than double the minimum regulatory requirement. Among the largest banks identified as Category 1 by the Fed, State Street and Morgan Stanley demonstrated the highest ratios under the stressed scenario, while Bank of America and Goldman had the lowest, below the aggregate but well above the Fed's threshold. This year's stress test scenario comprised a severe global recession alongside turmoil in the commercial real estate and corporate debt markets. It was tougher than the 2021 test, with a peak 10% unemployment rate and GDP decline and 55% slump in equity prices. The Fed's stress tests were established under the Dodd-Frank regulations with the goal of ensuring that banks can adequately support the economy during downturns. They help set a floor for the amount of capital banks can distribute to shareholders. The firms are expected, although not required, to announce their specific plans for buybacks and dividends on Monday after market. Mike?
Yeah, Leslie, and that obviously will be tuned in for closely. Let's now bring in Hennessy Funds portfolio manager David Ellison, and of course Steph Link still standing by. David, no big surprises expected. It shows you there is still quite a large systemic capital cushion out there. But what does it mean, I guess, in terms of the banks as investments from here? I mean, is it really going to reassure anybody when we're really more worried about maybe a more routine recessionary scenario?
Well, I think that, I'm sort of always amazed. There's $600 billion in losses and everybody's fine. It's like not a big deal, which is, sort of in the old days, it was like that was the whole industry was $600 billion. But, I think what it tells you is the banks have obviously played the game of being part of the regulatory structure, and the Fed doesn't have to worry about them, and they've got them kind of corralled, at least the top 30 or 40, in terms of a quasi, sort of regulatory framework. So I think that's good for the economy. It's probably helped the economy weather this decline in the market and the rise in rates. But I think this, I think the guest that was on prior to us coming on or me coming on talked about the sort of the change in the rate structure and that rates are up. And if that's a more permanent thing, where we do get rates, let's say the short end at 2 to 3 and the long end at 4, 5, 6, that's going to be significant for the banks for the next 4 or 5 years, because they've been struggling with very low rates, as you know. And because of inflation and because the Feds need to fight that, I think if we do get rates that stay here for a prolonged period of time, you're going to have a slow upward sloping margin, and you combine that with some loan growth and a few other things, and I think you're probably in pretty good shape. So, yeah, it's sort of funny. Yesterday, the testimony in front of the senators yesterday, I sort of came away saying, the story is, inflation's bad, a recession is worse. So don't put us into recession. And so I think that's the reason why the market has sort of come back a bit.
Steph, the credit piece, right? So if rates are a little friendlier up at these levels, if we manage to stick here, and obviously they can kind of expand margins and maybe get some loan growth if the economy stays okay, does the credit piece have to, how much can it erode and I guess keep things intact for the bullish story?
Oh, I mean, you're at record low levels in terms of delinquencies, non-performing assets, non-performing loans. And so I think there's a lot of room to go. And in fact, we do get monthly data from some of the companies in terms of all those metrics, and they have been very, very strong. So, yeah, I think there's certainly a concern. I worry about that. But we're off such historic low levels. And again, I think that the capital piece is so important. These companies do have a lot of flexibility. Of course, we are seeing some reserve builds, I think, on conservatism. I'd rather that, right? So I think, yeah, I mean, look, these stocks are trading like at 1 times book. I mean, Wells Fargo is at 0.9 times book, right? And Morgan Stanley is rarely do I trade a Morgan or look at Morgan Stanley on a book. It's at 1.4. I mean, so some of these things are getting a little bit silly, and I think that's why I said before you want to be taking a look on this pullback.